So let's start with BHP Billiton, which of course is one of the world's largest diversified mining companies. I think if you put it all together, it's as big as some of the mega oil majors in the US market. We have a market cap which is slightly hard to calculate because you've got to add the BHP PLC, which is listed in London and here in South Africa, to the BHP Limited, which is listed in Australia and in the United States. Gets quite complicated, but as best we can tell, it's got a market cap of about 1.1 trillion rand. It's focused on iron ore assets in northwestern Australia, copper in South America, and oil in the Gulf of Mexico. I mean, I'm sort of simplifying a bit. It's got a few other bits and pieces, but those are the big three legs that it stands on. Price earnings ratio has sort of gone out of the window. I think there's some write-downs and readjustments. Gerbrand can give us a better indication of what he thinks its forward PE is. Dividends are still being distributed at a pretty high level, 2.44% is what it says there. What does the metric look like to you in terms of PE? Why is it saying negative there? Is that because of
look, there's a lot of write-downs, etc.
write-downs?
So it depends on how you look at it. But they're actually probably not making too much money in the latest numbers that came out. So the PE is not the right way of looking at some of these resources. Price to book is the better metrics for that. It currently trades at just above 1.3, I think, price to book, which is similar cheapest levels it's ever been from Billiton's perspective. It's a bit more expensive than some of its peers. And if you break it down, we normally like to break it down either by EBITDA or by revenue. I think revenue is probably the right way of knowing what you're buying at the moment. Then you're buying...
Do you mean by breaking down revenue contributions from the different commodities?
Yeah, so at the moment you're buying iron ore, the biggest chunk, then copper, then oil, and then a little bit of coal assets. So
okay. Let's look at the share chart because that gives you a picture of what's going on here. That's over 5 years, and that's what I was talking about. It did well up till about 2013, 2014, had a bad 2014, bad 2015, and then it's rebounded and is currently, up, like you said, about 2 times there from the lows of 2016, if you were brave enough to buy them then.
Yeah, look, we're still concerned about the iron ore level, and we're still concerned about oil
I remember
prices.
From
we
your
don't think oil
previous
prices
shows,
will
you don't
go back
really
to
like
$100.
iron ore all that much.
No, we don't. We still think there's a massive oversupply. These guys are low-cost producers, so they'll still make money. So I'm not saying they're not going to make money. And then, they've got that Samarco Dam, etc.
What about that? So that was the thing where the mine in Brazil basically broke the tailings dam, which dumped a whole lot of, I was going to use a different word, on the village below, and a lot of people died, and then there's cleanup, and the Brazilian government wants to sue them, etc.
Yeah, look, it's going to cost money. It's going to take time to reorganize that specific asset, and it will continue. But I mean, it's going to cost a lot of money. We normally strip once-off events out of companies' valuations, so we think it's not a bad time to actually enter the share price where it is at the moment. It hasn't recovered some of their peers. Yeah.
But they've done all of the cost cutting, they've optimized operations, they've sold off the stuff, or they've pushed it into South 32, which we'll talk about later. So they are focused where they want to be focused. Yeah. And so
they've still got a great balance sheet. I think if you look at net
debt. How important is the dividend to you?
Look, it's cyclical businesses, so I don't think it's that important.
Yeah, they seem to think it's very important.
Yeah, they do, but I mean, they've cut it already, and they're probably going to cut it in the future again.
Yeah,
so
exactly.
It doesn't concern me that much. Longer term wise, you need to look at capital growth on where you entered the specific investment. So.
Look, we owned Billiton in a lot of client portfolios up until about 2015, at which point we decided we didn't like the earnings volatility. We loved them, of course, for the 10 years prior to that. The question really for me is, do you see any sustained acceleration in the share price as a function of rising commodity prices? So do you think iron ore and copper and oil prices are going to go at least significantly higher?
Yeah, not in the near term, no. I don't think that, but I think the asset is underpriced at the moment.
Okay, so you're saying you're buying them, just even if they're just steady state from here, you reckon? So you're going
I'm happy with that strong balance sheet. I think if you take net debt versus market cap, it trades at about a 30% debt to market cap ratio, which is the second or cheapest one that we're going to discuss today from the bigger guys. So we like it, and we've actually increased our exposure over the last month or so.
Excellent. Okay, good. So you're going hot on that one. I'm going to go not hot, I think, just because we do review these often, and I still think that the timing is a little bit further out than people may appreciate.